In Surrey, BC, here is Susan. Good afternoon.
Yeah, good afternoon, both of you guys. And just want to know about the bank stocks. Is it a good time to buy the banks or sell? And the other one is a good time to buy gold?
Okay. So, Susan, I'll come at it from our standpoint as a firm. Our premise is that if you are making new investments, you want to focus on things that are doing well currently. We don't want to hope that things are going to get better. When I look at the Canadian banks versus the US banks, for instance, at the margin with low energy prices, that's a hindrance to our economy. And so we think that the Canadian economy is slowing, and I think that it's very possible we'll get a rate cut coming up shortly that could try to help that. But we've got a slowing economy. The Canadian banks are exposed to the Canadian economy. They're all different. But the dividend growth in Canada is likely to be slower. When we look at the US economy, they're a big beneficiary of low energy prices because it's a consumer economy, and their consumers getting better. So the US banks pay out less of their earnings currently than the Canadian banks because they were held back by the Fed. They're likely to accelerate their dividend growth as we go forward. They trade cheaper than the Canadian banks. So as a global investor, forget being a Canadian, if you've got a choice as to where to go, you're probably going to the US before you come to Canada. So at the margin, we think more money goes into the US banks. I'd focus there. You could take a look at a Wells Fargo. This has been a view of ours for quite some time. There's a number of big banks that are likely to be able to accelerate what they pay out.
Mary's in Brampton with the next question. Hi, Mary.
Yes, hi guys. I've had GE for quite a while. I've noticed they've been selling some of their, like the appliances, and they're thinking, is it better? Are they going to do better, or is it going to be like within the same, boundaries?
So, Mary, it's interesting. It's a good question about GE currently because, they are spinning out businesses, and they made an announcement about 2 months ago about spinning out big part of their business. Stock jumped, and it jumped from $23 to $28 in the course of a day. And very often when a stock does that and leaves a gap in the chart, over the next number of days and weeks and months, it'll often come back and fill that gap, which is just done like in the last few days. So I think that the long-term picture for GE is very positive. It's a company that's going through change. They've got great assets. It's a global business. It is an industrial, and industrials are under some pressure. They have a fair bit of business with the oil and gas industry. But I think that probably technically it looks quite good. You're not going to get hurt in it. It's paying you just under 4%. Don't be shaken out by the fact that it's come down a couple of dollars in the last 2 months. That's not such a big deal. Technically, it still looks very sound. And
am I right in saying that some of your industrial exposure is in auto parts?
Yeah, and so really that's more consumer, right? But that is where our exposure is. Companies like Magna and Linamar are big exposures for us.
We have Anita now, who is in Markham, Ontario. Hi there. Hi, Anita, go ahead.
Oh, hi. Oh, I didn't know it was my chance now.
That's okay, go ahead.
Okay, thank you for taking my call.
Sure.
My question is on Emerson Electric. I just want to know what your opinion is on that. When I bought it about a year ago, the balance sheet looked very good for this, and I don't know, it hasn't gone anywhere. I just want your opinion. I'll hang up and listen to you. Thank you.
So Anita, Emerson's a company that's gone from earnings growth to earnings deterioration. So the earnings have been going down over the last 2 quarters, expected to be down 18% this quarter coming up. They report in August. They missed the estimate by 15%. Revenue is turning negative. They are impacted by strong dollar. About 46% of their sales are in Canada and the US, the rest are international. So I would say, first off, the sector, industrials in general, are not leading this market. Second, companies that have a lot of global sales are having a tougher time in general. And third, at the company level, they just aren't seeing growth in their earnings and their revenues. So I think that there's better places to focus.
We have an email. This is from Bill in Winnipeg, and it's on Dollarama. Technically, it looks overbought. If you were to buy the stock, where would you get in for the medium to long term?
Okay. So, Bill, this is a big position for us at the firm. Consumer has been a focus, and retail in Canada is one of the few sectors that's been performing well. So Dollarama and Canadian Tire are positions for us. Dollarama's in an interesting position because, they build a new store, they pay it back in about 2 years. So it's not expensive for them to open stores. They get a great payback, and there's a lot of room for them to add new stores. So that's the first thing. The second thing is that when you look at what they sell, they've been slowly taking their price point higher. So it used to be things under $1, then went under $2. Now they're working towards $3. And as they raise the average price of the products, their profit goes higher. So it's a very profitable organization. It's not expensive for them to open stores. It's not inexpensive, there's no question. But Canada is less populated by dollar stores than the US. So when you compare to them to US dollar stores, it's more expensive. And it's also a sector in the Canadian market that is doing well. And so lots of Canadian investors are having to get funneled into 2 or 3 groups. But that's not likely to change in the near term. So stock's not very volatile. Use a stop loss, understand where you would decide to go to the sidelines. But given the way the market's been behaving, it's trading within pennies of its highs. That's a really good sign.
All right, we'll take a break here with David, and then we'll come back with past picks. We have 2 very well-known U.S. companies that did very well for David and his clients, and one less well-known U.S. energy company that David is now out of, and we'll find out why after this.